Stefan, I am so happy to sit with you here today. I've been looking forward to this conversation.
Thanks for having me.
Of course. And Stefan, you are the chief of blockchain at Zühlke Group. And we actually recently connected. Both I was, on LinkedIn, and I've been looking and tuning into your own podcast you have that is called Bitcoin, Fiat, and Rock and Roll, which I can highly recommend for the listeners today. And then I had the pleasure of meeting you at the Frankfurt Digital Finance, where we were both speaking. And I think we both come to the realization that we had to continue the conversation on air.
Absolutely. It was such a pleasure talking in that very spontaneous move. How do you call it? So we were very spontaneous at the conference. So you just recorded us live, and then 10 minutes later, we were live on social media, I think on LinkedIn.
Yeah.
And I found that very, very cool, very, very natural. And I was also looking very forward to this longer session here.
Yeah, and I really appreciate it. And I think we were both standing, listening into a conversation on the stage, and we were just like looking at each other, being like, should we just go and do our own little thing?
Yes, I think it was more interesting than yet another talk, because I think we are regularly on this conference and there are valuable talks, obviously, but not every talk is as meaningful to us as the other ones. And I think we used the time in a very valuable way to record our own thing.
I'm glad you think so. I thought so too, I must say. And Stefan, I started Patreon because, many of us are craving those raw conversation and also helping each other navigate this transit we're all in. And just before we went on air today, we just spoke a little bit about it as well in terms of this sense making. There are so many things happening in tech, and markets are constantly shifting. We're seeing new headlines every single day. And I was just speaking to a colleague the other day, and it really feels like keeping up is like a full-time job. And that's what I'm trying to achieve with the Patreon podcast. And then also from a personal perspective, I use these to challenge my own thinking and also kind of go into deep dives into topics like stablecoin and digital assets and blockchain that we're going to talk about today with people like yourself, Stefan, that are like in the midst of all of this. So that's also why we sit here today.
Happy to dive into my topics.
And speaking of today, we are going to dive into everything about like the dirty word of crypto. We're going to talk a little bit about agentic finance within stablecoins, and then recent research about hurdles, acquisition announcements recently, and much more. So, Stefan, are you ready?
Yes, I'm ready.
So let's dive into it. Just to frame our conversation for the listeners very quickly, and for all of you tuning in today, stablecoin is now reaching a $360 billion market here in March 2026. We're seeing that this is highly concentrated within a very few players in the market, still very focused on US dollars. And one of the things I wanted to dive into before we go into all the news and what's happening today, I wanted to reflect a little bit about the journey leading into today, because historically, crypto has been a little bit of a dirty word. What do you think, Stefan? Like, what changed over time as we reflect back to understand where we are today and the phase that we're now in?
First of all, I think crypto is now a more dirty word than ever before, because there are still some scams around and price manipulation and stuff like that. I think many people who got rich quickly in the past and maybe lost their wealth again in the next downturn, they now went into different areas like betting sports. I don't know what they're doing these days, but I think a lot of people are quite sober about crypto these days and buying defense stocks, or I don't know what the speculators are doing. So I think all this craziness is a bit out of that market. The speculators are looking for other opportunities. And crypto always was maybe a dirty word, especially for banks, because also crypto positioned itself as killing banks or creating a new financial market without all the problems that some people see also with banks in certain areas or under certain circumstances. And I think for for the regulated industry, the regulation for stablecoin, especially in Europe, changed everything. That's my personal experience. So when I tried to, or maybe one word about my company and what I'm doing, I'm working for Zühlke. We are an innovation service provider with nearly 2,000 people in Europe and Asia. So we try to help our clients to adopt new technology of any kind. It's absolutely not restricted to blockchain. It's across the scene, from cloud to cybersecurity to AI, you name it. And blockchain is just one little part of that whole thing. We did projects for the last 10 years in that space, trying to analyze if you could tokenize real estate to create CBDC solutions, stuff like that early on. And I always wondered, why is it so hard for banks to understand that whole crypto thing? Because, dirty word and speculation and stuff like that. And what really struck me 2 or 3 years ago was how different the crypto thing was perceived once MiCA came in place. Because what I didn't see is that banks operate on money rails. And if you don't have a digital form of money on a blockchain that's official legal tender, or that you can operate on, when you have to discuss the money thing, then everything else is even more complicated. So actually, I think for Europe, MiCA changed everything. That you have at least kind of an e-money solution that's running on blockchains. You don't have to think about that too much, as you need some licenses to get involved. But there's a rather clear path. In Germany, BaFin sets the rules, and if you behave according to the rules, then you have the money thing solved somehow. And without that in place, you don't need to talk about tokenized equity or other crazy things, because you need the cash leg to pay some kinds of interest, or to all that surrounding things are not in place if you don't have the money solved on chain. And when you then fantasize about DVP and atomic swaps or all the other good stuff around blockchain technology without having the money leg in the same technology, that's simply a showstopper. A showstopper. And with that, for me, everything changed. That now most of the banks are looking at that, looking deeply into that, even thinking about issuing their own stablecoin, because Tether earns so much money. Everybody notices that it's not easy to replicate because it is regulated. And Tether earns the money with a less regulated version of a stablecoin. So actually, there are also downsides to this development. But the stablecoin laws were the absolute unleashing moment that helps everything else. And now the US kicking in and finding the Genius Act and stuff, and getting the regulatory side in place for many, many different things than even money. That's additional support for this new take on the crypto space, from my perspective.
Yeah, and we're going to dive into regulatory a little bit later in our conversation as well. But I do find it interesting that once the regulators have green ticked something, you finally see all players across the ecosystem diving into it, not just the first movers and the disruptors. It reminds me a lot of the open banking space as well. Many aspects, I would say.
Absolutely. I couldn't agree more. So actually, I'm quite close to the guys of Gnosis and Safe, and there are very, very good presentations from these guys that actually say this is kind of open banking 2.0.
Yeah.
With because we also talked about that in Frankfurt. For me, it's about unbundling and rebundling parts of financial services on top of wallet infrastructure and blockchains. So the Gnosis guys have a nice picture where in the past, when you wanted to engage with a bank, you first need to open a deposit in order to get access to financial services. So everything is tied together. So you need to have the deposit, and everything is built around it, and the bank owns the relationship to the client via the deposit. Nowadays, with this new infrastructure, you can bring your own wallet, actually. You can bring your own assets in your own wallet under certain circumstances, let's put it like that, what the regulator allows. But actually, you could come with your own wallet, similar to a deposit, and say, okay, just plug your financial service into my wallet because I come with my wallet. And that's very much of what open banking was all about, that you have kind of a plug and play architecture. That's what all these DeFi money Legos built over the last 5 to 10 years.
Yeah.
So I would really see that as the technological unleash for open banking, actually, that we now have very different technological rails in place to really implement open banking. And very differently than it was imagined maybe 10 or 15 years ago.
I think it's very fascinating because the way that I have understood and kind of the way I think about stablecoin and blockchain is that it's an additional rail, additional system where money movement can happen. And back in the day when I was at a scale up within open banking aggregator here in Denmark and across Europe, we're looking at this as like the challenger to how do you pay and how do you get paid. And I'm seeing that same concept play for stablecoin and the blockchain. I think, again, looking back at how open banking became a thing is, again, it became a regulatory movement. And I wanted to hear, because it's one of those things when you enter in a new phase of digital transformation, new opportunities to pay, new rails to pay on, and it challenges the current setup, just as stablecoin is doing. Which use cases do you see that are the first movers in the digital asset space with the blockchain?
I actually wrote in my latest newsletter issue about that whole thing, what's going on, and I think I thought a lot about that. And you can find lots of articles that handle stablecoins. But for me, first and foremost, you need to distinguish between retail use cases and more institutional use cases.
Yeah.
Let's look at retail first. There again, you have to distinguish use cases for developing markets, where stablecoins fill a gap where the banking infrastructure is not as good as it could be. And stablecoins are very attractive, for example, to get exposure to US dollar because they are denominated in US dollar usually. So look at Argentina, where the local currency might not be as good as you want it to, and you have strong restrictions in the banking system to even hold more than 100 US dollars. And there people find ways, maybe even around their local regulations, to get exposure to US dollar via stablecoins and wallets. So that's a clear use case in Argentina and other South American states, but also in Asia and Africa. On top of that, you have the whole remittance game, where now people who work abroad send money home, avoiding the old guys like Western Union or other things. So it's very cheap, very fast. You don't get charged 15% on the transaction. You can pay 2 cents or so to get US dollar stable coins back to your home country, to your family. So these are all these developing country use cases around stable coins where Tether went big. And not many people know that, for example, Tether invests in 10,000 kiosks with solar roofs in Africa under the condition that they also accept USDT. Yeah. So they do really development work out there to get their stable coin implemented in these countries. Not many people talk about these use cases. They are really, really helpful for the rural communities out there.
Yeah.
Not everything that Tether does might be perfect, but there are very, very noble aspects about that whole thing. Yes, they earn money with that, but they also help these people. And that's the flywheel that stablecoin issuers like Tether create primarily in these developing markets. That's that story. The developed countries' use case is clearly tied very much to crypto and trading. So in the early days, that's also how Tether got big with Bitfinex and as their exchange. So to actually trade crypto, it was easy to stay on the same rails. So if you had a Bitcoin USD pair, this was tied to stablecoins, especially on the decentralized exchanges where you needed to have a trading pair, crypto on both sides. So you invented crypto dollar form, and that was USDT and later USDC. So that explained why in the developed countries, stablecoins were a thing. So you exchanged your normal fiat dollars against stablecoins and then got into trading, or you sent your fiat dollars directly on exchanges like Binance and Kraken and traded. And then there was an arbitrage opportunity between these centralized exchange venues. So people sent their dollars then on the rails because it was much faster than go back to fiat. So you stayed in the system. That's a very important thing. These people were very close to crypto all the time, and they wanted to stay on chain, not off chain, because that was usually very expensive because someone charged a high fee to get money in or out of the system. So that was a developed, but also very retail heavy. What we see now in the last 1 or 2 years is that the big players like Stripe create their own blockchains with Tempo that are very much focused on utilizing stablecoins as a core rails for their core business. So that's a kind of a cost-centered scheme that you say, okay, we use the traditional fiat rails, but actually going with stablecoins is cheaper for us. It's even open if the cost savings are given to the clients, or if they just earn more money because they get cheaper. PayPal is going that route. I heard a story that up till last year, so PayPal also owns Venmo, and up to last year, you couldn't send money from a Venmo account to a PayPal account for technical reasons. Now they can use PayPal USD to do exactly that integration. So these use cases are much more internal now in the whole payment schemes. And let's see where this leads, because it's much less open. Yes, they claim to be permissionless with Tempo blockchain and Arc blockchain by Circle, and also Tether has Plasma blockchain. So now these big payment players use their own stablecoin, use their own payment coin optimized blockchain to serve with better conditions, and whoever makes the money, let's see how that plays out. So that's that institutional realm, very much focused on payments, not so much related to crypto, where we see that we see unfold now. Tempo was just going live last week. And then we have even other aspects in the capital markets, where we talk about DVP and the whole realm now of exchanges, when you buy digital assets, when you buy tokenized stocks in the future, where you also might need stable coins or other forms of tokenized digital money to pay. There, I think the verdict is still open if this goes more with wholesale CBDC or stable coins or some form of tokenized deposits. I don't know what will happen there, but I think stable coins have a right to play there too, if the counterparty risk is managed, etc. But there, the questions that get asked are very different. So how safe is actually holding hundreds of millions in a certain stable coin? What if Circle goes bankrupt? Do I get at my money? So there again, in this very institutional case, there are still other questions to be asked. So that's how I see that whole space, and the maturity of these different use cases is very different. The remittance thing is 10 years old and developing at a rapid speed. The crypto thing is quite old and established. Stripe and stuff, that stuff is quite new, but very promising, happening now while we speak. And the institutional cases, I think are maybe 1 or 2 or 3 years down the line, and stablecoins need to compete to other forms of digital money.
And I kind of wanted to dive into what you just said a little bit more to understand like why it matters. All these movements you were saying about, talk about Stripe, Tempo, PayPal, right? All these movements, we might be able to also add the recent acquisition announcements with the BVNK for MasterCard, right?
Yes.
Because again, from my open banking acquisition days, we got acquired by MasterCard as well. And they talk about this multi-rail strategy, which is exactly the same as when they acquired open banking players. Because again, it's this concept of however and whenever you're moving money and getting paid and so forth, they want a stake in that. But the way that I'm thinking about blockchain and stablecoin and so on is about almost removing the middleman and looking at and faster ways to have the relationship between the merchant and then the customer. And what I find very fascinating is that when we got acquired, for example, we had to go in and delete where we have been saying, directly speaking about removing the middleman. Yes. But what is it that you see is happening now with the cases you highlighted here? And what is it that people should keep keep a watch for? And what's still uncertain in all of this?
So I think old intermediaries are replaced by new ones. That's for my first thesis. So I think the old intermediaries were very much playing at a regional level. So you were strong in a certain jurisdiction. That was your benefit. You engaged yourself into a certain supply chain for money or payments, let's say. And there you were very strong and you established a strong partnership. Whereas in the new realm, I think there we will see global intermediaries that are either Stripe or others, or maybe players who are close to Stripe and that serve that market globally. For example, salary payouts based on stablecoins, also a thing we currently see unfold. Another use case that might be very interesting if you have employees from around the world and you can easily pay them with stablecoins and don't have banking relationships to Ethiopia or Kenya or I don't know, you just want a wallet. Yeah. So many interesting cases. So I think we will see new intermediaries. Very interesting about Visa and MasterCard is that even if you use crypto like so I use a crypto Visa card for nearly everything I pay with, but it's the last mile problem. Yeah. So the last mile problem is still dominated by these credit card companies. And I think Visa did a fantastic job to be relevant. So they have so many different partners, many crypto players. Where
they're partnered with both Circle and Bridge, right?
Yes, exactly. But also the players, even like Gnosis. So I'm using Gnosis Pay, for example, which is a very crypto native company. But yeah, how do you spend your stablecoin? Yeah, you need to go through someone like Visa in that case. And I think MasterCard is less strong traditionally on that level. So most successful players partnered with Visa, to be really honest. And I think this billion worth of acquisition of BVNK is actually a sign of we need to move now, because Visa is eating our lunch regarding these crypto native users, actually, because Visa has quite some strong partnerships in place there. I think the main reason for this acquisition of BVNK to catch up and say, well, okay, actually, we have a strong customer base there. We have a strong technical solution that brings us maybe head to head with Visa again. The interesting question for the crypto players is, do they accept that the credit card players avoid being Kodak? Yeah? So kudos to these two players. They didn't sleep. They see it coming. They similar to BlackRock and other trade.
Yeah.
It's about survival. It's about acknowledge. Actually, it's the strongest acknowledgement of the technology that players like BlackRock, Visa, and MasterCard pay that amount for M&A stuff to come up with new solutions and admitting, okay, we don't even know if we can keep the margins as high as in the past. Something's moving here. So that's for me the ultimate proof that we talk about the how and the when, but not the if. This is coming because these strong players invest a lot of money, and for them it's absolutely clear that this is the future. Maybe it takes some time, but that's the wake-up signal for everybody else who's still watching or just preparing custody solutions and not really going into that business and actually actively or even aggressively offering better conditions, better solutions, more digital solutions to their clients. These guys are showing us where the future is. And the interesting thing for the crypto guys is, okay, you always promised strong alternatives to these old players, but where is it? So do we pay with QR codes, dynamic QR codes, where you can directly pay stablecoin from your wallet? How fast is that? How open is that? Which blockchain is used then? Are you there where the users actually are? And that's all resolved by Visa. We all know it's not about payments. It's also about insurance and really getting at the money if something goes wrong. This whole acquirer network. Everybody wants to get rid of the acquirer network, but then again, you enjoy the services that Visa and others serve beyond the payment itself. It's more complicated if you dive deeper into these use cases. And that's the open question for the crypto folks. How can they actually compete on the last mile with these players? And that's different in the developing markets. When we talk about these kiosks in Africa, I think they seem to find ways to actually make it an end-to-end thing with solutions from Celo and Opera Mini, going more on mobile use cases, etc. So that's very different from the developed countries. For crypto, I think that's a very interesting thing. Is it compelling enough in the developed countries to replace Visa or MasterCard? I got some doubts.
Where you see in the different markets, developed or not, is that direct merchant to customer relationship sustainable or not? benefits that we just are so used to now with other players in the ecosystem that we would not want to necessarily move them. But it's going to be interesting to see how that business case will evolve over the next couple of months, I suppose.
What we see is the sovereignty discussion in Switzerland and Europe. So with Twint, for example, in Switzerland we have a paying scheme that could replace some of the American players. So Switzerland is heavily discussing that topic. How can we? There's a lot of money going out through American acquirers and players that charge quite high fees, also for smaller merchants. That's also a political discussion. If the sovereignty, like we see with cloud usage and AI usage now, everything dependent on the US, is there enough political motivation and economic motivation to really come up with something that's competitive against US players? That's far more complicated done in reality. And do the users, the consumers in the end, buy into that? Is it convenient enough? Is it cheap enough? That's the question for entrepreneurs these days. I don't know whether the established players will be the answer to that, or whether there will be some strong startups who fill that gap and say, we play the sovereignty game here and come up with modern technology like stablecoins, maybe in combination with AI to create an alternative to these old networks. Let's see.
I was having a conversation, and not to dilute our conversation here about sovereignty, but just to add to that, Stefan, I had a conversation the other day about that. Like, how realistic is it actually for us to do that in Europe? Because terminals, our phones, everything is American. So is it still just this romantic narrative that we have about, bringing everything home to Europe versus the reality of how feasible would it actually be?
I think it will start with government spending. So where does all the money go? Do you focus more on European players or not? I think that needs to start there somehow with funding more local stuff. We see some of movements in Germany to push for local AI factories and stuff like that. But let's see how far they get. I totally agree. It's first about the fundamentals. That you still might be even needed to force some of these players to open up their app stores and stuff like that, to even create technical capabilities that you can pay by tapping and stuff like that. A lot of stuff has happened there regarding regulatory openness, but let's see who actually gets in and how these players defend. And they have obviously lots of possibilities to answer these regulatory aspects somehow in a nice or less nice way. I think it needs a lot of money, a lot of political willingness to actually change something here. I think the consumers alone won't do it. Usually it's very easy to say, then buy something else. I think that's not enough.
Exactly. I wanted to hear from you, Stefan, because earlier here in March, the Coinbase CEO Brian Armstrong had been out talking about agentic commerce. And he was talking about how stablecoin will be the kind of mechanism to make that a reality. And you also yourself hosting an event coming up here in a couple of weeks about exactly that. What's your take on that?
Yeah, actually, I was really fascinated last May in the week when Coinbase dropped X402. So that's a very cool new standard. Maybe we need to explain a bit. So what Coinbase used is an HTTP status code that's called payment required. It was invented in 1996. So in 1996, someone wrote a spec that it could be useful if an HTTP server could answer with, before you get access to this resource, you need to pay me. And that's 402. And interestingly, it was never implemented in the last 30 years because we didn't have the technical ideas how to do that. I find that extremely interesting because that's the reason for all the ad traffic and the subscription model. So actually you have two business models in the web. Either you pay for a subscription and get access to resources, or you finance yourself via showing ads. And that brought all the Web 2 craziness we see with all the bad sides, extracting value through the attention economy.
Yeah.
And I think the answer to that is Coinbase X402, where they say, okay, we interpret that standard in a new way. The server answers with payment required. Here's the wallet address. We accept these stablecoins, and it costs 2 cents if you want to access this resource. In HTTP, no crypto stuff involved, pure HTTP server. And the client can say, okay, I pay that with my wallet, and I create a proof that I did it. and I send it back in the HTTP header so that I get access to that resource. Actually, that's an extremely elegant way. So the technical guy in me says, okay, that's the future, because they created a very small standard, open sourced it, and brought an implementation. Coinbase wants to earn money with that for sure, but you can implement your own version of that. And I thought, okay, that's it. With stablecoins, we now get agentic commerce going, because you could easily imagine you pre-fund your agentic wallet. Yeah, you give your agent a wallet and say, okay, everything below 5 cents. When you need to do research for me, I fill $5 in there. Go with it and tell me if you need more. Yeah? So fantastic. And you can easily imagine where that could lead. We all know these newspaper sites where you would once in a month read an interesting newspaper behind a paywall. That's the answer. I think it's very naive to think that there will be no answer to this nice idea, because obviously all the players now come up with their own standards, starting with Google and AP2 and others. Last week, Stripe announced MPP. That's very similar. That's even using X402 for certain stablecoin things, but you can also use it for giving your agent access to your credit card under very strict rules. So they create policy frameworks around that to make that feasible. Because Brian Armstrong sometimes says, okay, there is no credit card for an agent, but there will be. Obviously, all these players, like we just discussed about Visa and MasterCard, they are innovating the hell out of that whole thing. And if they see an opportunity to earn money with credit or debit cards with agents, they will obviously find a way and work around the blocking things that we saw in the past. So I think it's a bit naive to say, or it's deliberate to say there is no credit card for an agent. Yes, but there will be, or there already is. They will come with alternatives. They will come with different payment, with different schemes for how expensive that needs to become much less expensive. But the question is, can they deliver it? And if so, how? So maybe they use the stablecoin below their whole credit card mechanism. So that's again the same thing like with Stripe. So all these old players, they innovate on top of the new rails. They might hide them away. It's just the same API as before. It gets cheaper, and in order to become cheaper, they are using stablecoins themselves. So the question is, do the users benefit by direct access to stablecoin payments? If they are clever, they would. Or do they pay 1 or 2 or 3 or 5 or 10% extra charge for the convenience with the old players? And only the future will tell which one will win. I think it needs to be convenient. I wish for the open solution, actually. But we know the users. They usually go for the convenient, easy stuff. And that's an interesting thing to watch how it plays out.
It's going to be very interesting with the whole agentic. I think it's going to be, there's conversations about how search engines are changing, how we discover products are changing because of LLMs. You have your Claude or your ChatGPT or whatever, right? And then how are we all purchasing stuff? It's gonna be fascinating to see how that's gonna change. But to your point, you still need something to hold the money. The
Absolutely,
assets, right? So
I think it would be great to have wallets there. And to be honest, what's very interesting is stuff like EIP 8004. So that's a new Ethereum standard that tries to become the registry for agents. So imagine you want to book a trip to Spain for holidays, and you say, okay, I've got a limit of €2,000 to go to Spain, maybe with my partner. And you agent, you are my personal agent now. By preferences, I want to go into small boutique hotels and do a little road trip, and let's do it for 5 days, or I don't know, and I want to be at the coast a certain time. And then you trust that agent, and it books a trip in Italy instead of Spain. So who is liable for that, and what could possibly go wrong, without maybe trusting, again, Booking.com as the intermediary for that whole thing? So that would again, same situation. So either you directly interact with an agent, but if something goes wrong, the question is, so
who's reliable?
Who's liable for something going wrong? Or does actually Booking.com or others use these agents to give you another service that you don't have to think so hard, because they know all about you? And actually, they should be very motivated to know more about your preferences for travel. So this will come, obviously. And for that, for example, this 8004 standard is created to create kind of a permissionless registry where agents can prove that they do their job in a very good way, kind of a reputation system for agents. So you see a lot of stuff happening there. It's live on Ethereum and other EVM blockchains by now. The activity is not yet there as some people want us to imagine. Yeah, it's taking more time to build the trust that people spend significant amounts of money for real world actions with these agents, but that surely will come. And will be, again, a very interesting competition between very convenient centralized players we know from the past who will absolutely adopt this technology, or maybe more open standards, open technologies where you can pick and choose, and will be, again, depend on the consumers which route they will take, or new fintechs or new travel techs or however you call them, who see a value in their build their brand fast, cheap. Maybe we see the new Airbnb in that space that's organizing our travels via agentic stuff, or Airbnb comes along and says, okay, we have an agent for you.
They are going into the whole experiential, experimental, space. So who knows? And again, to your point earlier, in terms of with signals in the market, right? You also have Visa just going in announcing that they're now officially having a program in Europe around agentic commerce. And then again, Stripe and OpenAI have done a collaboration around agentic commerce. So it's going to be interesting to see how this space is evolving. Stefan, from your experience and with the conversations you are having, what would you say the listeners should pay attention to? What's still not clear that we should keep an eye out on?
Oh, it's a lot of stuff. That's my job to be the signal in the noise. That's why I want clients to engage with us, because we think we can come up with relevant market signals that might have a structural impact on their business. That's what we offer as a consulting to challenge their digital asset strategy or their digital money strategy. We don't know. Usually we don't know the world of the banks or the clients better than themselves. So it's a joint effort. Yeah. So they need to think about how does it impact us. We can come up with these signals and make them think, okay, you might be unbundled here and you need to think about your future role. What's your future role when payments run on stablecoins and you don't have the stablecoin? What's left for you? What's your role? What do you want to be in the future? I think that you need to really contemplate about that now. It's not just about creating wallet infrastructure for anything. You really need to think about the future. How would it unfold? What if players like Stripe Paper get even more dominant, if they serve your clients better than you can? So what's left for you? And which capabilities do you need to build up in that future? And you need to regularly check in with the development in the market. So we think that's actually a continuous exercise. So what we try to do is continuously sell our services into that market to make sense of what's going on out there, and work together with the clients to say, okay, that's actually something you need to set up and prepare for the future. At this point in time, there are several things that are going on. We see, for example, on-chain vaults, a very interesting thing that could define the ETFs of the future, that it's far cheaper to run a fund or an ETF on-chain and have it automatically scale out in the future. But we also see on the money side of things that you are interested in, that ERP players like SAP are building native money rails with a digital currency hub, where banks might even be out. That in the supply chain, you pay directly via stablecoin to your partner companies in the supply chain, and might use stablecoins for that. Many different things are going on. Agentic payments is another signal that you need to be very serious about, because most banks, for example, still invest in mobile banking or the user experience, but an agent doesn't care. An agent only plays on an API level. You need to be fast, you need to be reliable, you need to be cheap. Your brand doesn't pay anything back, because there's no human that judges your brand appearance anymore. It's all about performance, cost, etc. Yeah. So these are very fundamental questions where you might be pushed back into an embedded role, being an embedded bank or an embedded payment provider, or I don't know. But you need to think about that. What what's left for you in the end. Or if you want to shape that thing. I think most banks don't shape it. They just prepare for something or defer reaction to these whole movements. But now I think it's about time to wake up, because you will need 2 or 3 years to prepare capabilities properly and give an answer to that whole development.
It's super fascinating that we are all in this transit, right? Everything is moving, and you better be on that train while it's leaving the port, because if you're not, then it's too late, perhaps, or at least you have a lot of catching up to do. And speaking of, like, for you as a bank or any other player, understanding your role and the future of the market and how it looks like in the future, the way customers are navigating and so on. Just a few days ago, the Clarity Act was announced to step forward, which I thought was really interesting, also into this concept of what the role is, because the way that I understood it and that I see it is that stablecoin, again, were directly challenging the core of banking with deposits, right? Which is now what the Clarity Act have said, that actually stablecoin cannot go in and earn money on holding the money and therefore earn on the deposit, but it can still use or get paid. The commercial model can still be in terms of the initiatives on why you should use stablecoin for paying and getting paid in the future. What's your take there?
I think you can't contain these developments with no regulation in this world, because money and life will find a way out of that box. For example, for years, I think it's a bit, the whole discussion about yield-bearing stable coins is a bit over the top, because people are not used to these new rails and the possibilities of these new rails. For me, for the last 2-3 years, I say stable coins are money in transit. I only need stable coins for payouts. As soon as stable coins settle down in a wallet, I would always exchange it for something yield bearing of maybe a very different character. Actually, we created a comic 2 years ago about how we imagine, maybe we can link it in the show notes, but it's 2 years old. So about how we might imagine the whole money flowing around in 2030, we call it fluid money. And we played with stablecoins, CBDC, and tokenized money market funds. Because as soon as a stablecoin settles down and you hold it for 2 or 3 days, you can easily exchange it for a tokenized money market fund that brings you 3% yield. Or you put it into a crazy DeFi scheme and you earn 5 or 10% yield, depending on your risk appetite that you have. Do that seamlessly for the users if you have the right licenses in place. An example of a fintech that does that, maybe on blockchain rails, but maybe not, is Trade Republic in Germany. So if you put some money on Trade Republic, you get 2%. You as a user, you don't know what's happening. I learned that money is put to a certain degree into money market funds hosted by Deutsche Bank or DWS. So quite a significant player behind the scenes. And you don't care. You actually don't care. You are somewhat in a secured environment. You get insured by BaFin to a certain extent for the first 100K. But that's, for me, the playbook of the future. Users don't care which kind of money it is, as long as it is somewhat insured and you have not a dramatic counterparty risk, or your money is going in a crazy part of the world. So if it's somewhat regulated by the local regulation and you have a somewhat decent player there, then this player will find a way to make most out of your money, and that will win. And over time, this will change the rails, because simply for these players, it's cheaper to do it on a blockchain and use stablecoins for pay in, pay out, use tokenized money market funds to earn yield if there's enough euro-denominated tokenized money market funds, which might not be the place now to go big with that, but this will obviously come because it's simply cheaper. And yes, it will take time. It won't happen tomorrow, but there's no way to avoid that development. It's as simple as that. You can buy time, but you can't change that future because cost efficiencies will bring it down. And my prophecy is there that it's still taking some time, but then at a certain time, when everything falls in place, when different asset classes are there and you can easily swap A to B, then it might happen quite fast. And some players will be quite surprised by how fast it's going, and they are absolutely not prepared for that future. That's what I try to achieve in my talks to banks, that, hey, it's about time to get your stuff ready, to get prepared, to get at least the infrastructure ready. It's not so much about the use cases. Everybody is forced to think in use cases, but this is also a defense play. You need to be ready when this thing kicks in, because then you don't have much time to react. When people get an easy chance to get 5% yield on something instead of 0.1 on their deposit, because then when ordinary people start to, when it's time gets tougher, like with this crazy geopolitical situation, and money is earned a harder way, and your neighbor knows how to earn 5%, and you still have the money in your bank and get nothing. This will change the picture quite dramatically when ordinary people have easy ways to swap out of that system that doesn't work for them anymore. And then you can argue about the importance of banks with lending out money, yes, but people will vote with their feet, I guess, at a certain point in time.
I think it's fascinating to follow, and there's just so many news happening every single day and week. And as I started out saying, it's a full-time job to figure out what's going on. So it's great to be able to join a conversation with you, Stefan, to help navigate and make sense of everything that's happening and understanding what all these signals mean and why you should pay attention. And I think it's safe to say that things are moving now, and that you can't just sit on your hands and hope for it to be a reality in 5 years.
Absolutely.
Stefan, I have absolutely joined our conversation. We're coming to an end. Your honesty and energy is always a pleasure. I'm so happy, and I'm sure it's not going to be either the first or last time that we sit together and trying to debug what's going on.
Thank you for having me. It was a true pleasure to talk to you again, and I hope you get very successful with this podcast. I really enjoyed it, and hope the listeners took some value out of our conversation.
Absolutely. And where can people follow you if they want to know more?
I'm easily to be found on LinkedIn. That's kind of my home turf, constantly posting stuff there. I've got a newsletter there. Obviously, I also have an email, but maybe just ping me up on LinkedIn. That's the easiest way to find me.
Yeah, perfect. Thank you, Stefan, and I will speak to you later.
Cool. Thank you for having me.
Thank you so much for spending your time with us. I hope you enjoyed the show. If you have feedback, topic ideas, or guest recommendations, we are all ears. Pantrum is growing thanks to our community of listeners. So if something resonated with you, we would love for you to share your favorite takeaways. And just a quick note. The views shared by our guests are entirely their own and don't necessarily reflect the companies they work for. That's it for now. Thanks again for tuning in. Until next time.